Every time you enter a trade, there is someone on the other side. When you buy, someone sells. When you win, someone loses. This is not a flaw in the system. This is the system. Trading is a zero-sum game. For every dollar you make, someone else loses a dollar. For every dollar you lose, someone else makes a dollar. There is no other outcome. The money does not come from a magical pool of infinite wealth. It comes from other traders. Most traders never fully accept this reality. They think about the market as an abstract force. They say things like, the market took my money, or the market was against me. But the market is not a person. The market is not a force. The market is a collection of other human beings, each trying to do the exact same thing you are doing. Take money from someone else. In this video, we are going deep into one of the most uncomfortable truths from Chapter 2 of Trading in the Zone, the zero-sum nature of trading. You will learn why this reality creates so much emotional pain. You will learn why successful people from other fields struggle to accept it. And you will learn how to use this truth to your advantage instead of fighting against it. Let me define what a zero-sum game actually means. A zero-sum game is a situation where one person's gain is exactly equal to another person's loss. The total amount of wealth in the system remains the same. It just changes hands. Poker is a zero-sum game. When you win a hand, the money you win came from the other players at the table. The casino takes a cut, but the players are trading money back and forth. No new money is created. Chess is a zero-sum game. When you win, your opponent loses. There is no draw where both players win. One wins, one loses. Trading is a zero-sum game. When you buy a stock and it goes up, the person who sold it to you lost the opportunity to make that profit. When you sell short and the price drops, the person who bought from you lost money. Every trade has a winner and a loser. This is the hard reality that most traders try to ignore. They want to believe that everyone can win. They want to believe that the market is an engine of wealth creation for all participants. But that is not how trading works. Mark Douglas understood this clearly. He wrote that in the market, the only way one trader can benefit is if some other trader loses. This is not a theory. This is the mathematical structure of every financial market. Think about your last winning trade. Where did that money come from? It did not materialize out of thin air. It came from another trader who was wrong. Someone who sold when they should have bought. Someone who bought when they should have sold. Someone whose analysis failed. And think about your last losing trade. Where did that money go? It went to another trader who was right. Someone who saw something you did not see. Someone who acted faster or more decisively. This is the zero-sum game. And until you fully accept it, you will carry an emotional burden that makes consistent trading impossible. So why do most traders struggle to accept the zero-sum nature of trading? The answer is simple. Because in almost every other area of life, zero-sum games are the exception, not the rule. In business, you can create value. You can build a product that helps people. You can grow the pie for everyone. Your success does not require anyone else to fail. In fact, your success can create opportunities for others. In relationships, love is not zero-sum. Loving one person does not mean you have less love for another. Friendship is not zero-sum. Making a new friend does not cost you an old friend. In education, learning is not zero-sum. When you learn something, you do not take knowledge away from someone else. Knowledge can be shared infinitely, but trading is different. Trading is a transfer, not a creation. The stock market can create value over the long term through economic growth and dividends. But trading itself, the act of buying and selling, is a transfer of wealth from one participant to another. This creates a psychological problem. Most successful people have spent their lives in positive-sum games. They have been taught that hard work and intelligence lead to success without harming others. They have been taught that cooperation and collaboration are virtuous. Then they enter trading, and suddenly, they are in a zero-sum game. To win, someone else must lose. To be right, someone else must be wrong. This feels wrong to them. It feels unfair. It feels like the market is personal. Douglas writes that many traders feel betrayed by the market. They feel like the market owes them something. They feel like their hard work should be rewarded without anyone else suffering. But the market does not operate on social values. The market operates on supply and demand, on buyers and sellers, on winners and losers. Until you accept that your win requires someone else's loss, you will carry a hidden resistance. A resistance that makes you hesitate. A resistance that makes you second guess. a resistance that makes you lose. The zero-sum nature of trading creates another danger. It makes traders take the market personally. When you lose money, it is natural to ask, who took my money? And when you find an answer, the market, the institution, the smart money, you can begin to feel victimized. You can begin to feel that the market is against you personally. Douglas warns against this. He writes that the market is not a person. The market does not have intentions. The market does not know who you are. The market does not care about your hopes, your dreams, or your account balance. The market is simply a mechanism, a place where buyers and sellers meet, a place where prices move based on the collective actions of thousands of participants. None of those participants are thinking about you. None of them are trying to take your money specifically. But when you take losses personally, you enter a dangerous mental state. You start looking for revenge. You start trying to get back at the market. You start trading with anger instead of strategy. Revenge trading is one of the most destructive behaviors in all of trading. It almost never works. It almost always leads to larger losses. And it is driven entirely by the inability to accept the zero-sum nature of the game. Think about a gambler at a blackjack table. When the gambler loses a hand, does the dealer laugh at him? No. The dealer is just doing a job. The gambler lost because the odds were against him. The gambler lost because he took a risk. The gambler lost because that is how the game works. Trading is the same. The market is the dealer. The market does not care if you win or lose. The market simply facilitates the transaction. When you lose, you lost because the odds did not work in your favor. You lost because you were wrong, not because the market targeted you. Once you stop taking losses personally, you stop looking for revenge. Once you stop looking for revenge, you stop making the worst trading decisions of your life. This is a critical step toward consistency. One of the most surprising findings from Douglas's work is that the people who struggle most with the zero-sum nature of trading are often the most successful. People in other fields, doctors, lawyers, engineers, CEOs, entrepreneurs. These are people who have built successful careers by creating value. They have been rewarded for their intelligence, their hard work, and their ability to solve problems. But in trading, those same qualities can become liabilities. Because trading does not reward value creation. Trading rewards being right while someone else is wrong. A doctor saves lives. That is positive sum. The patient wins. The doctor wins. Society wins. Everyone feels good. A trader profits from a short sale. That means someone else lost money. The trader wins. The other trader loses. Society is neutral. No one feels good about the loser. This is uncomfortable for successful people. They are used to being admired for their contributions. They are used to creating win-win outcomes. They are not used to winning at someone else's expense. Douglas writes that this discomfort often manifests as hesitation. The successful trader knows the right move, but something holds them back. A voice in their head says this feels wrong. A voice says, do I really want to take money from someone else? By the time they act, the opportunity is gone. The hesitation cost them the trade. And then they feel frustrated, not understanding why they cannot execute. The answer is simple. They have not fully accepted the zero-sum nature of trading. They are still operating with a positive-sum mindset. They are still looking for win-win. But in trading, win-win does not exist. To be consistent, you must accept that your win requires someone else's loss. You do not have to like it. You do not have to celebrate it. But you have to accept it. Otherwise, you will hesitate. And hesitation is the enemy of consistency. Now let me tell you how to use the zero-sum truth to your advantage. Because once you accept it, you gain a superpower that most traders do not have. The superpower is emotional detachment. When you understand that losses are not personal, you stop reacting to them emotionally. When you understand that wins come at someone else's expense, you stop feeling guilty about them. You simply execute. Douglas writes that the best traders are not the smartest people. They are the ones who have learned to separate their ego from their trades. They do not need to be right. They do not need to prove anything. They simply follow their edge. This is possible because they have fully accepted the zero-sum nature of the game. They know that being wrong is not a character flaw. It is simply a market outcome. They know that being right is not a moral victory. It is simply a market outcome. Here is a practical exercise. Every time you enter a trade, say to yourself, someone is on the other side of this trade. They think they are right. I think I am right. One of us will be wrong. That is the game. This simple acknowledgement does two things. First, It reminds you that the market is not personal. Second, it reminds you that you do not need to be right every time. You just need to be right more often than you are wrong over a large sample of trades. Another way to use this truth is to focus on your edge, not your opponent. You cannot control the other trader. You cannot control their analysis. You cannot control their emotions. You can only control your own execution. The casino does not worry about the individual gambler. The casino does not try to predict which gambler will win. The casino simply trusts the edge. Over thousands of hands, the edge produces consistent profits. You must do the same. Stop worrying about the person on the other side of your trade. Stop wondering if they know something you do not. Stop trying to outsmart them. Simply trust your edge. Execute your plan. Let the zero-sum game take care of itself. Let me leave you with this. The zero-sum nature of trading is not a problem to be solved. It is a reality to be accepted. Every trade has a winner and a loser. When you win, someone else loses. When you lose, someone else wins. This is not unfair. This is not personal. This is the structure of the game. Most traders never fully accept this. They carry emotional baggage from the positive-sum games of their professional lives. They hesitate. They second-guess. They take losses personally. They seek revenge. And they lose. The consistent trader accepts the zero-sum game. They do not like it. They do not celebrate it. But they accept it. And that acceptance frees them to execute without emotional interference. In the next video, we will continue exploring Chapter 2 with another angle. The final video on Chapter 2. We will bring all these concepts together. The unlimited freedom, the denied impulses, the random rewards, the zero-sum game, and the path to thinking like a casino. If this video helped you, hit subscribe. Stack another brick. I will see you in the next one.